Thanks for joining us today on Market Call. I'm Marella Fernandez. Christine Poole on the show today, President and Co-Chief Investment Officer at Davis Rea. She'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266. You can email your questions as well. Market Call at bnnbloomberg.ca. Good to see you. Thanks for coming in.
Thanks, Marilla.
We have a new inflation set of numbers out of the U.S. Obviously, energy is hitting there. What do you see as the longer-term effects of the conflict if it carries on?
Well, obviously, if it carries on, the duration is longer than what the market's anticipating, then gas prices and crude oil prices stay elevated. And as you say, Marilla, it's going to translate into higher inflation. We're already seeing at the pumps in North America. Gas prices are much higher than they were pre-war. So that's the risk that if energy does stay high and it starts to filter down, and it's not just crude oil, because there's a lot of other chemicals that are being, because of the disruption, that it's going to filter onto different products. So generally higher prices. And meanwhile, unemployment or employment is, in the States, is still pretty low at 4.3%, but it is slowing employment growth. And we're seeing in Canada, our unemployment is quite high. So we have a sluggish economy. We're not in recession, but things are slower. So that combination of higher prices, households are going to have to pay more for goods and services, combined with weaker employment is not great. And so it puts central banks in a very difficult position. As you know, we've gone through a rate cutting cycle. In Canada, we're largely done. In the U.S., it was anticipated they would cut a few more times before the Iran conflict erupted. Now we're thinking, the consensus is that they ought to stay on the sidelines. So central banks, I think they're taking a wait-and-see attitude to see if this is just a temporary short-term supply shock. But the greatest risk is that if inflation does stay high and continue to climb, then the central banks might be forced to start raising interest rates. And then you have that combination of slow growth, high rates. Stagflation is not what you want, and it doesn't usually end well.
And you do not see, despite what's going on, a recession on the horizon?
Well, the indicators that we're tracking, in particular in the United States, leading indicators like the ISM Manufacturing Index and the Services Index. The manufacturing index in the States has actually turned positive for the fourth consecutive month, meaning that activity is expanding. It actually had been contracting for most of last year. And that's really coming from the increase in capital spending we're seeing for data centers, artificial intelligence, et cetera. On the services side, it's been positive for the last 22 consecutive months. So those leading indicators show that the economy is still expanding, but the prices paid index for both those surveys is also rising, which is implying higher prices. So we have to monitor that closely.
You do see earnings growth carrying on for the rest of the year?
Well, as you know, that's probably the story, Marilla. In the United States, the market's at all-time highs. Very narrow, though. Leadership's narrow. But the earnings is coming through for, if you look at the index as a whole, all the companies in the S&P 500, earnings for the first quarter are now forecast to be up 28% year over year, but largely driven by technology. And then for each subsequent quarter this year, growing over 20%, and then around 23% for the year. And for next year, 15%. So right now, analysts are not projecting a significant slowdown. And
you don't see energy costs going up or anything related to that affecting big tech, possibly bringing earnings down?
The argument is that artificial intelligence data center build-out is a long-term secular growth theme. So that will not necessarily stall the growth if energy prices go up. But we also know there's power. The lack of power is also an impediment to growing these data centers. So eventually, companies have to see a payback. And if you see weakening demand despite spending all this money, you might see a pullback in that build.
Let's take a quick break, then we'll line up the first phone calls for Christine Poole, Davis Rea, taking your questions on North American large caps. Here is how to reach us both by phone and email. Back in a moment. Welcome back to Market Call. We're going to start with an email from Frank. Frank says, could I please have Christine's thoughts on Shopify? Christine Poole with us today. Shopify, we know, is always volatile.
Yes.
And the software concerns have played out for them. So they haven't recovered from the hit as many of the stocks in that space have not.
Obviously they offer, their products are great for companies that want to do e-commerce and sell online. and they're experiencing really good growth. And they reported about a week ago, I think, Marilla, but the numbers for the quarter were fine. But the guidance going forward, I guess their growth going forward is still pretty healthy, but it's moderating from what they've done in the past.
They used to have, yes.
The market doesn't like that, especially when the multiple, the price to earnings multiple on Shopify is very, very high. So when you're trading at a very high multiple, you have to live up to those growth expectations or even more for you to continue to do well. And so, the stock has pulled back. And so I guess really for valuation reasons is the reason we're not in the stock.
Have you ever invested in it in the past?
I do not own it in our segregated portfolios, but we do have a position in our kind of larger growth-oriented portfolio.
Okay. Let's go to the phone lines then. Chris is on the line in Delta, BC. Chris, go ahead.
Oh, good morning, Morella. Christine, Great to have you back on the show, as always. I would love to ask you for your current thoughts on Abbott Labs, please. I know it's been a long-term pick of yours, and I've done well with it over the long term, but it's really come down lately, and I've been using this as an opportunity to add and essentially building it up to a core position of maybe 5-6% of my overall portfolio. I would just like your thoughts if you still see this as a good long-term compound investment, and I will hang up and listen. Thank you as always.
Okay, sure. Thank you for the question. What are you still in Abbott Labs?
We still own it, and it's been a very trying time this past year. I mean, generally speaking, healthcare seems to be out of favor.
Yes.
You look at a lot of healthcare names. Very similar chart.
Nowhere,
yeah,
yes.
It's like implying that there's no more growth and there's no more demand for their products. I don't believe that. Abbott is a diversified healthcare company, medical devices, diagnostics, established pharmaceuticals, which is like generics that they sell to emerging markets. And, they did very well during COVID because there's a huge demand for their diagnostic products. And so they had to kind of, go through that. And now that's largely behind them. And they still have some great products that are doing really great growth. The last quarter when they reported, they actually brought their guidance down by like 0.5%, but the market doesn't like that. Got hit pretty hard. So I think that, it's still a core holding and we continue to hold it. They did have some increased competitive activity in some of their products that they offer, and they're addressing that. They did make a recent acquisition as well called Exact Sciences, which is diagnostics in the cancer treatment area, which they feel will provide good growth going forward. It is dilutive near term, and I think some of the analysts, when they were modeling their numbers for Abbott, they really hadn't included that dilutive impact. So once again, negative near term on their earnings profit outlook, but longer term would be a good growth source.
I was going to say, why have you decided to hold on to it?
Yeah, for those reasons, and the valuation, it's trading, has come down quite a bit to a mid-teens multiple, and traditionally Abbott trades over 20 times forward earnings.
Let's get to the next caller then. Rich is on the line. He's in Vancouver today. Rich, go ahead.
Oh, hi, Christine.
Hi.
I'm calling about Zoetis. It's been trending down for a while. Last week, they missed on their earnings and they cut their guidance going forward. The stock got really hammered.
Yeah.
I'm down quite a bit on it. Do you recommend that I continue to hold it or perhaps rotate to something else?
Okay.
For the question. This is animal medicine?
Yeah, they do animals. So they have Pet Companion, which is your pets, as well as livestock. Each is about half of their business. And we've held it for a number of years, and it's been, also in that healthcare space. However, Zoetis, they've had some headwinds the past couple of years. They had launched a new product called Umbrella, which is a pain management drug for dogs. It'd been out there for cats for many years before, but it got some negative press that, it was actually having harmful effects for dogs that were using this drug. But many times when you're giving this treatment for pets or for dogs, they have pre-existing conditions. They're usually elderly dogs. So
it's like a pain management medication?
Yeah, arthritic pain. So, it's been okayed by the regulatory bodies, and their studies have shown that the vets, like the drug, but it's gotten some negative press. So that's kind of slowed the growth of that product. And then more recently in the last quarter, and I think historically, Zoetis has always been pretty defensive when the economy slows or you go into recession, because generally speaking, people are very attached to their animals and they will spend to take care of them. Yeah. And so in this last quarter, I guess what probably caused the stock to fall that sharp, because they did reduce guidance, but not very much, was that they actually saw price sensitivity, in particular in the U.S. market for pet companions. So people are now being a bit more sensitive about what they're going to spend on their pets and the uptake on some of the medication they provide. So we'll have to monitor that closely, maybe because we've had a tough consumer environment, especially on the lower end for so many years now, past COVID. So perhaps that's had compounding its effect. But meanwhile, the livestock division is doing quite well. So this is medications for livestock. And that's actually offsetting some of the negative effects they're seeing in the United States. But I think that was what caused the stock to drop more. And once again, now Zoetis is trading probably at about a 13, 14 times forward multiple. And typically it's usually way higher, like in excess of 20 or 25 times. So I think a lot of the negativity is reflected in the stock price. We still hold it for our accounts. We're not adding to the position right now because I do want to see how this plays out over the next couple of quarters. If this price sensitivity continues, because we might have to reassess the thesis behind the stock. But for now, we still hold it.
All right, let's take a quick break. We'll get to more of your phone calls and your emails for Christine Poole, Davis Rea, when we come back. Stay tuned. Welcome back. Let's go to an email from Carrie. Carrie says, can you please comment on CCO, so this is Cameco. They reported today with positive news. Stock rose early to over 169, and after the good news dropped back down to 157, that range. Would you buy it at this point? Are you invested in sort of the uranium space? Is that part of what you own?
Well, we don't own Cameco, but obviously that is play on nuclear and nuclear demand in the future. We are involved through Westinghouse, which is half owned. Well, Cameco actually owns 50% of Westinghouse, and then Brookfield owns the other 50%. So we are playing it through Brookfield Renewables and then through Westinghouse, which does a lot, as you know, Marilla, they service a lot of the reactors out there, as well as they have a reactor model that is being built out potentially in the United States. And so for Cameco, I mean, it is, there's not a lot of really large cap direct plays for nuclear. So that's probably one of the reasons the stock, has done quite well over the last year or two because of the resurging demand for nuclear. But it is a long-term play. They are the largest producer of uranium out there, low-cost producer. We just have chosen to play it through the Brookfield Group on the Westinghouse.
Do you see any reason for that stock to pop on news and come back down? There's nothing overhang.
No, not particularly. It just could be, obviously you have to believe that nuclear prices are going to be higher in the future than they are now, right? Because, the combination of production and pricing is what is going to drive their top line. So if you look at the models out there for Cameco, most analysts are projecting higher prices in the future. And so that has to unfold. Now, if we see nuclear builds, either they're delayed or the sentiment turns against nuclear, then that would obviously impact Cameco.
Okay, let's go to the next caller on the line. Michael's in Vancouver. Michael, go ahead.
Hi there. Thanks for taking my call. I'm just wondering about, first of all, I think Christine Poole is like the girl of bosses of all bosses for business.
What's your question, Michael?
My question is on Amazon. I'm just wondering if it's a good investment since the boondoggle sent big check.
Okay, we'll take a look at Amazon right here. Of the Mag 7, is Amazon one you own?
So we don't own Amazon in our segregated portfolios, our client portfolios, but we do own Amazon in our growth fund that my colleague John O'Connell manages. So it is like what we consider it a growth stock. Obviously, they have their, everyone knows Amazon retailer, AWS, which is a cloud provider. They're getting good growth there. They have actually the largest market share. And they're actually starting, I think, to offer their supply chain services to their customers or clients as well now because they've built it out internally. And so they have a huge network built out. So, yeah, I mean, I think it is a very sound growth company. And like I said, we do own it in our growth equity fund.
Let's get to the next caller then. Lou is in Gatineau, Quebec. Lou, go ahead.
Bonjour, ladies. Christine, I bought a small position in Otis Worldwide when you recommended it. Now I'm down 10%. I'm wondering what to do. Should I buy more or just sit tight? Thank you for taking my call. Bye-bye.
Thank you for the question. Tell me about Otis. What do they do?
Yeah,
Are they
so
the elevator company?
Yes, elevator and escalators. And it's been around for a long time. It was actually spun out from United Technologies, which is now RTX. But so we've owned it since we owned United Technologies prior to that. And then we kept Otis when it got spun out and increased our position. It's a very interesting model that the elevator industry has. It's an oligopoly. Otis is one of the largest. Schindler and Kone are their competitors. They're European companies. But there's a nice service model to the elevator industry. You buy the new equipment, which is the actual elevator, and then usually there's a service contract attached to that. And it's usually multiple years, and you get the margins on the service contracts are much higher than it is on the new equipment. So and let's say in the past, go back 5-10 years, a lot of the new equipment orders was driven by China as they were building out their infrastructure. That has slowed. So new equipment for China has actually been negative for the last, three years or so. China is about 9% of Otis's revenues. New equipment generally had been soft the last few years, but now the company is starting to see an inflection point in new equipment orders in the Americas and in other parts of Asia, like India, where they are seeing growth. But more importantly, elevators are getting older, and usually, it's very regulated. Like you don't want your elevators to break down. You have to get it serviced after a certain amount of usage. And so elevators are aging, in particular in Europe, where they have a big presence. And so they're starting to see increasing modernization demand, where companies actually replace the whole elevator system. And so that's starting to come into play, and so which is positive, because services now is becoming a bigger picture of the overall growth profile of the company than new equipment orders is. So the stock has pulled back a bit. I think really on the fact that new equipment had been so weak. Now services is starting to improve. New equipment is starting to improve. The company is investing in their service network because they're trying to increase the attach rate, which is when a company buys the elevator that they sign the service contract with Otis. They don't necessarily have to, because there's independent service providers, in particular in China. It's very diverse and fragmented there. And so they've been really focusing on increasing the attach rates to these orders. And so they're investing in their services team. That's impacting their margins a bit near term, but I think longer term, that's the right move, and we continue to hold it.
Okay, let's take a quick break then. We're going to come back with past picks from Christine in just a moment. Time to go through past picks from Christine from April 21st of last year.
Yeah.
First pick at the time was CGI, so GIB.A on the TSX at 144.33. Now to 86.84, so 40% downside, total return 39%. I'm trying to peg when the software concerns started. Clearly, it was after that date, and a lot of these companies remain depressed.
Yes.
And I'm wondering if you are picking and choosing ones you think will recover, and if CGI is one of them.
Yeah, so we've owned CGI for a long time, Morella. I think we started buying this stock in 2011, and it's been historically a great long-term growth compounder stock. Managed services and consulting are their two businesses. So managed services is outsourcing companies that, their call centers, et cetera, their back office. And then systems consulting, and which is more of the consulting side. And usually that's a leading indicator for the managed services business. So you're right, Morella. I think the AI concerns started hitting the market maybe,
mid last year?
Yeah, when Claude, all these
Claude,
models started coming out with pushing. And so, yes, it is going to increase the productivity and the speed of doing lots of technology-related functions or administrative functions. And for CGI, they're in this consulting business, outsourcing business, and it's not just, you saw this chart, the whole sector's been decimated. And And I think, their last quarter, for CGI, their organic growth has been soft. It's actually been negative for the past year or two. Combination of one, there was all these cost-cutting efforts in the United States when Trump first got in, and then there was a government shutdown, and the U.S. government is a customer of theirs, so they saw the effects of that. But now they're starting to, the comparables should get better, and they're actually anticipating that they'll have positive organic growth in the back half of this year. And then secondly, Europe is about 45% of their revenues. And Europe, in particular, with what's going on in the Middle East, because Europe is much more dependent on imported energy, whether it's LNG or crude oil for their energy consumption needs. And so their economy is soft, and they saw that, you're seeing delays. Companies are delaying investment decisions about taking on projects. So that's hit them. So it's really a function of time, I think, for this to play out. Meanwhile, stock's trading at less than 10 times forward earnings. Company announced this morning a change in the CEO. It's the chief operating officer is stepping up. But I think it's a recognition. The board is recognizing the poor performance of the stock price. And they can grow through acquisition, which they will do. But I think the market wants to see positive organic growth. So that's going to be a catalyst to get these stocks going again.
Have you exited the position in any way?
We have not exited. We're not aggressively adding, but we're holding. And I think it's overdone. And at some point, when things stabilize, we'll probably build up a position again.
Let's get to your next pick from April last year. JPMorgan in New York at the time, $228.99 US to $298.10 today. So 30% upside and then 33% total return. I imagine you've held on to a full position, if not added.
Yeah, we continue to hold JPMorgan. All the banks had a great year last year, as you know, Marilla. Same with the Canadian banks. And JPMorgan is the largest, very well run. Jamie Dimon is the CEO, the most profitable, a very strong balance sheet. And actually, in times of distress, like if you recall back in 23 when we had that regional banking crisis, that allowed them to buy First Republic, because and which usually they probably wouldn't have been allowed to buy another large financial institution because of their scale and size.
So exceptional circumstances.
Yeah, but then when there's trouble because of their balance sheet and their strength, the government probably essentially asked them to come in and take it over. So we think they're very well positioned. The U.S. economy, even though Jamie Dimon is infamous for being very cautious and making very cautious statements and highlighting the risks out there, so far in their financial results, they've been very strong. They really haven't seen that play out. So yes, and provides a dividend yield. We think this is the bank to own for U.S. exposure.
Let's get to your third pick then. RTX Core, RTX out of New York. At the time in April of last year, it was 126.12, so U.S. up to 177.56, 41% upside, 43% total return. They're essentially defense. Yeah. I'm wondering, with the conflict in Iran, does that bode well for them this year?
Yeah. So they're half defense and half commercial aerospace. Pratt & Whitney manufactures engines, and then Rockwell Collins does many airplane parts and components. So once again, they have that new equipment and aftermarket set up for the commercial aerospace side, and the aftermarket is obviously very lucrative because you're servicing the engines. And the defense business is going very strong, and Marilla, and not even, you mentioned the Iran conflict, but it's also the Ukraine-Russia war. That's also, it's been a few years now. And so you're seeing many governments increase their defense spending, so that will be beneficial to RTX. And in fact, their backlog is at an all-time high. And international orders are becoming a larger component of their backlog. I think it's over 40%. And the company says that international business tends to be more profitable than domestic. So we continue to like this stock. There is a little growing concern about, if this Middle East crisis continues and oil prices stay high, are airlines going to cut back their flights? People are going to travel less and potentially may impact the aftermarket, let's say in a year or two. So that's very early. We'll have to monitor what happens with the conflict. Besides that, though, we think they're very well positioned for the defense side. U.S. government is also increasing their defense spending. And the commercial aftermarket, people continue to travel. It's a global...
Would you buy in today where it's at?
I would actually buy it today, yeah. It's pulled back a bit, so I would.
Let's take a quick break on that note. We're going to get back to your questions for Christine Poole of Davis Rea. Again, she's taking your questions on North American large caps. Back in a moment. Welcome back. Mike has written in. He said, I would like to get your guest view on CNR for the long term. Thank you for the question. The rails, I know generally people like. They think, it's built. No one else is going to build it.
That's right.
Invest in that. But my concern would be trade, CUSMA review, that kind of thing. What's your take on the rails right now?
Yeah, no, you're right about that, Marilla. You're right. No one can replicate their network, right? And so, it's hard assets, tracks in the ground. We actually own CN Rail, and it's the one rail we own amongst the group, and it's been a long-term core holding. The stock, the last couple of years, the stock has pulled back, or its valuation multiple has contracted. They had some issues in terms of just labor issues, strikes, port strikes that impacted the amount of volume in their network. And then as well, the economy in Canada was a bit softer than they anticipated when they gave their guidance. And they've been reinvesting in their network. They think that's largely behind them now, and they actually reduced their capital spending plans last year, and they're going to redeploy that excess cash flow to buying back stock. So, we've seen in the last few quarters that their network is functioning very smoothly in terms of dwell time at the terminals, how fluid they move, and so it seems to be well positioned for a pick up in volumes if the economy improves, and they're well positioned for operating leverage because their costs are going to come down. And meanwhile, in terms of their valuation multiple, CN used to trade at a premium to the group. Now it's trading at a discount. So that's one of the reasons we continue to like it quite a bit, because it's trading about 17 or 18 times forward earnings.
The push to remove barriers between the provinces to trade would also be very helpful to them, I imagine. But I'm not sure if that's happening in fits and spurts.
I really haven't heard too much about the interprovincial trade. But you're right that, we do have CUSMA coming up, so that may impact volumes. You've seen certain sectors where tariffs have been applied, like the lumber industry, that's hurt traffic volume shipments. So that's something to watch out for. But despite that, we know that, we have this fiscal stimulus to promote more infrastructure build, more trade with international markets. That should benefit the rails. And the rails can also take share from trucking, because it is much more economical and cost effective to go by train, and that's why the initiatives to increase productivity and being on time, that's so important, because that, if they can do that, they can show to their customers that they can expect on time and delivery. And so, those are the reasons. And, it is kind of an oligopoly. Mm-hmm. It is. We've seen some M&A activity in the industry. I don't know there's going to be many more left. So, like you say, the network's out there, and we're shipping goods, just-in-time inventory, all that bodes well for transportation stocks in the long run.
Let's go to the phone lines then. Carl's on the line. He's in Toronto. Carl, go ahead.
Hi, Marilla. Thanks for taking my call. Christine, I know you're a fan of WSP Global, as am I. I realize that the engineering companies have been whacked lately, but in the case of WSP, we're talking about down close to 25% in the past 3 months and 10% this week, which to me seems very excessive. So I would appreciate your reaction to this. And one final comment. I've watched you for years, and I'm surprised that in the last couple of years you haven't talked about Chartwell, despite the fact it's done extremely well. So I just thought I'd throw that out there. Thanks very much, ladies. Have a great day.
Thank you very much. So what is going on with engineering? Because we do expect them to be beneficial in the infrastructure build.
Yeah, but they're also getting involved in this whole AI disintermediation, thinking that their clients or customers will demand less of their services so they can do some it themselves. I don't really buy that thesis, because, as WSP and many other engineering firms have pointed out, when you're building a bridge or a building, you're not going to put some AI program. Like you're talking to so many different parties, having to coordinate, and someone's got to sign off on, be liable for it, right? But despite that fact, that sector has been under pressure as well. We've seen that a lot of stocks in that group. Their chart looks like that. And WSP, when they reported their numbers about a week and a half ago, I thought it was a very strong quarter. Their margins were ahead of schedule. They're improving. They've been making very good acquisitions with nice vertical market exposure, power in particular in the United States. And so I'm a little surprised the stock is off so much. It had also always traded at a premium to the group because they don't have construction exposure, which is one of the reasons why we had bought WSP. It's purely services and consulting. Construction is where a lot of these companies get in trouble. So maybe the multiple has come more in line with the group, which maybe account for some of the price decline. But we continue to hold it, and we think they're very well positioned in the coming years for infrastructure building, environmental, all those reasons.
Let's go to the next caller. Then we have Gord on the line in Aurelia. Gord, go ahead.
Hi, my question is on Canadian apartment REITs, CAR.UN. They took a hit last week. Are you still a fan?
How do you feel about REITs?
We don't have a lot of REIT exposure, but it is an asset class. I guess it's an indirect way to play real estate instead of holding the building or the real estate directly. So Cap REIT, we have a small position. We had bought it as an income stock a few years ago. They are going through, with the decline in immigration and international students, that's impacted them on the margin. But what they're going through now is that a lot of the leases that were signed during COVID or just around COVID, the rents were much higher. And as we know, rents have come down. So those are they're short-term leases. And so those leases after like 1 or 2 years, the tenants are exiting those leases and they have to release that space at a lower price point. So they're going through that. Whereas their older leases, the markets in those rental agreements are still much lower than the market rents. But we have to kind of let this play out. So that's why the stock, I think, has come back. But it's trading at a very attractive multiple. I think a lot of the bad news is reflected in the stock. And it's really just kind of waiting. It's a matter of time for that rollover of the short-term leases for the pricing impact to flow through their rental base. But we continue to hold it for now.
That was for Gord. Let's take a quick break. We're going to be back with your phone calls for Christine in just a moment. Stay tuned. Welcome back. Ghulam's on the line in Toronto with a question. Ghulam, go ahead.
Hi, good afternoon. My question is on Sienna Senior Living.
Oh.
Is it a good buy at this price? But my main question was BlackBerry. I see in the last 3 months it's been creeping up.
Yeah.
Okay, so are you asking about BlackBerry or Sienna?
I need both, actually. But
Okay, let's dig into that then. Let's start with BlackBerry because they reported earnings and they're saying they've turned that corner to become more of a sort of for the vehicles.
For the automobiles. Yeah. So I haven't, to be honest, Meryl, I haven't followed the stock that closely.
Okay.
And so, like you say, it does seem like they've stabilized and their software is being used in automobiles. And so, I really don't have too much to add. I think we want to see more visibility, more sustainability in that growth avenue to make sure they are actually going to be able to grow consistently.
Okay, let's get to Sienna Senior Living, of course, in the retirement space.
Yeah.
Obviously, they'll benefit just from population getting older.
Yes, demographics.
But what else do you look at for something in this sector?
I mean, it is about demographics, and we do have an investment in that space. And the prior caller did actually mention that name, Chartwell Retirement Homes. So that's what we own in that space. And the reason why we own Chartwell versus Sienna, because Chartwell is all private community, private homes, private retirement homes. They're not long-term care, which is funded by the government. And so we like that aspect because it's privately funded. We like the demographic profile, obviously, because people age. There's more demand for retirement homes. But Sienna still has a long-term care portion of their portfolio. Maybe it's about half. I think they're trying to increase their private side of the business. And then going forward, I think it's positive for the industry as a whole. We haven't seen a lot of construction new starts the last couple of years because of higher interest rates. And so for the next year or two, I think we're going to see supply be below demand. And you're seeing, the occupancy rate at Chartwell is above 95% now. Like during COVID, it got below 80. And like
are they doing acquisition? Can they go that way?
They also are making acquisitions and doing recycling, meaning selling kind of non-core properties, older properties. And more recently, for Chartwell, they actually signed a joint venture agreement with Fengate they're going to own 30% of this portfolio of retirement homes, and they're going to manage it with the potential to increase their interest over time. So it's a source of new development growth, and the occupancy in that portfolio is around 86%. So they feel they can increase the occupancy, so that would give them more operating leverage. But the main reason to have exposure in the retirement homes is what you said, Morella, demographics. We're all aging. There's generally speaking, a shortage of facilities. And people, on the private retirement home side, people generally sell their residential houses to fund the move into these homes.
Let's get to the next caller then. Jason's on the line. He's in North Bay, Ontario. Jason, go ahead.
Yeah, good afternoon. Thanks for taking my call. I'd like Christine's opinion on Pfizer. If you ever owned it, and your opinion where it is at these levels.
Sure.
Thank you for the question. What does Pfizer have going these days?
Well, a problem is they're going through a patent cliff, and there's not a lot of, they're working on their pipeline and doing acquisitions to offset the patent cliff, but they've got a few large drugs that are going off patent. And so that's been the problem with this stock. They did very well during COVID because of the vaccines. Mm-hmm. And then after that, so they were trying to redeploy that cash, the profits, to address the pipeline issue. So far, I think analysts are not seeing a lot of growth for the company for the next few years. So it's trading at a pretty low multiple. We did look at it actually post-COVID when the stock started to come off, but we actually didn't see the visibility to offset what I just described. And so even though it is trading at a very low multiple, and I think it's probably got a pretty attractive yield, we haven't stepped into the stock in that space. If you want a large cap pharma stock, Johnson & Johnson is the one that we've stayed with. We've owned and we've stayed with J&J. And they're actually, they have a few drugs going off patent as well, but they've been able to offset that and still grow their top line through their pipeline. And they've done some acquisitions as well to supplement their growth. So we actually think JJ's is the better health large cap pharma company to buy in that space.
Let's squeeze in one more email before we take a break. Remy wants to know about Nvidia, which will be announcing earnings May 20th. Would like to get some idea. Is it a hold, sell, or buy? Before the announcement, Nvidia is just looking up, was $219 earlier in the day, down to $217 right now. But record territory for the stock here. Would you buy more Nvidia where it is today?
I would not buy it. Generally speaking, semiconductor stocks, we don't really have a lot of exposure in that space. Obviously been the wrong call the last 2 months because that's been roaring up.
Tearing, yes.
Tearing up. But Nvidia, they're the leader in that space for all the, we all know the data center build-outs, their chips. But there is more competition. And a lot of their own customers are building their own chips for inferencing. And so, the growth is not going, and the big question is how long can this growth continue for? Is it near short term? Because semiconductors typically is quite cyclical, but they've been experiencing very good growth. But I would not step in here. I think there's more competition, probably a lot of expectations for the stock, their results. And so not interested in owning the stock.
Let's take a quick break. We're going to have new top picks from Christine when we come back. Stay tuned. Join us tomorrow for Market Call with Nick Mersch on the show, portfolio manager at Purpose Investments. He'll take your questions on technology stocks. That's tomorrow. Let's get to some new top picks from Christine Poole. We're going to start with Enbridge, pipeline company, TSX. Why do you like Enbridge? I know they've got build out coming through for them. Obviously, they've been doing well in this time with the energy crisis. But what do you like about Enbridge?
Well, Enbridge has been an income stock in our client portfolios for a number of years, and we do like it. It's largest pipeline company in the world. Transports about 30% of the crude oil consumed in North America. They have a natural gas pipeline as well. They have a gas utility portfolio they bought from Dominion a few years ago. So that more regulated, very defensible business stream, and a growing renewable portfolio. And they've been signing new projects. In fact, they just signed one with Meta, an onshore wind project that's going to come online in 2027. And the company themselves said that management has said in the last call that this is like the best set of growth opportunities they've seen in the last 10, 15 years. And I think with all the geopolitical uncertainty, the conflicts, there's a growing global need for secure energy supply. So, Canada and the U.S., they serve 75% of the refineries in the U.S. Gulf Coast, so that they've got great market access. And then as well, as we know, our government wants to encourage energy infrastructure build out so that we can ship more to international markets. So if that happens, then that'll be beneficial for all the pipeline companies because you need transportation services. But first, as the CEO said, we need to see higher production growth from the energy producers. So that really hasn't materialized yet. So we got to see growing production. We have to see fiscal support, indigenous support for new pipelines. But meanwhile, they're seeing lots of growth opportunities in the United States. And it gives you a yield of about 5.5%. They've been growing that dividend for the last 31 consecutive years. And we see no reason why that dividend can't continue to grow through the balance of the decade.
That was Enbridge. Let's get to your next pick. Loblaw Companies Limited, L on the TSX. Groceries, more of a defensive move for you?
Yeah, it's a defensive name, in relatively defensive growth company, I think. Largest food retailer and drug retailer in Canada. And so on the food side, they had a new CEO come in a couple of years ago, and he's really refocused on their exposure in the discount banner, which is no frills.
Which has done well.
It's done very well, especially in this kind of challenged consumer environment. The discount banners have been outperforming, and they've actually been opening new stores in under-penetrated areas in Canada. And they also have a very established private label portfolio, which is 35% penetration in the categories that they participate in. And so they usually make more money. It's higher margin than the private labels. And as well with, consumers very price aware, they may tend to buy the President's Choice products versus a branded product that usually sells at a lower price. On the drug retail side, which is Shoppers Drug Mart, great locations, once again, about a 30% share. And we're seeing expanded scope of services from the pharmacists. They're able to prescribe medications for minor ailments. And I think that scope's going to continue to expand, and that drives traffic into their stores. So the back end is the pharmacy, and they're seeing really good same-store sales growth there. And then the front end is all your cosmetics and your food and drug goods that you see. And you're seeing, and I think you probably noticed some of their locations have more food in them.
Yes.
Smaller units, making it more convenient for people who live in apartment buildings or condos to kind of get everything. So we like that. The demographics play in their favor. The stock actually has done quite well. It's pulled back a little bit, I think more just because of funds flow into the more growth-oriented sectors. But we think they're very well positioned. And like you say, it's a great defensive company to own.
Okay, we've got about a minute left for your next pick, which is Visa, which has gone a little sideways. We've had a lot of people ask about what's going on with Visa and MasterCard. I imagine you've been invested for a while, and you've held here?
We have held. And, they reported a very strong quarter, top line, 9% volume growth. They're not really seeing a weakness in discretionary or non-discretionary demand. People are spending. And in fact, when you think of Visa and MasterCard, even if prices go up and you're using your card, whether it's debit or credit,
they're still making money.
They're still making money, right? And so, and they're increasing their value-added services business. It's about 30% of their revenues, which is not transaction related. It's merchants, hiring them to do marketing services or cybersecurity, fraud prevention. And so we think that this transformation to digital payments from cash and check, it's still ongoing. Yes, in North America, it's been largely penetrated, but in many parts of the world, people are still using cash as a form of payment. And it also participates in the growth of e-commerce because you're using a digital payment for that as well.
Okay, that was Visa. Got to leave it there. Thanks for joining us, Christine. And thank you for joining us today. We'll see you back here again tomorrow.